Ahead and get started. So, Chapter 16, Introduction to Managerial Accounting. And this chapter starts in your book on page 827. Our learning objectives, we're going to define managerial accounting and understand how it's used, describe the differences between service, merchandising, and manufacturing companies, classify costs for service, merchandising, and manufacturing companies, prepare an income statement and schedule of cost of goods manufactured for a manufacturing company and calculate cost per item, calculate cost per service for a service company, and cost per item for a merchandising company. So our first objective is to define managerial accounting and understand how it's used. So why is managerial accounting important? Most everybody thinks that there is a right or a wrong. There is, there's extreme this or extreme that. But in all, so they use the term, we tend to think of everything as being, that you see the pebbles here, either black or white, but it's really not. There is a lot of gray area. And that's where it is very important for you, if you work in business, if you are a business owner, if you work in business in any kind of way, and even in your personal life even, you can use what you learn, a lot of what you learn from this class in your personal life, as far as your finances, budget, all of that good stuff. There's a lot of gray area. So the truth is that, we want to have a prosperous society, or we want to have a prosperous life. We want to have, we want to prosper in our personal lives or our businesses. And to do that, we have to make good decisions. And in order to make good decisions, we need to use reliable, useful information in order to make those decisions. If we're trying to, if we're thinking about buying a car, and, the information we have is about our, I don't know. If we're looking to buy a car, we need to have information relevant to us being able to make those car payments, right? That's the information we need to use, the relevant information to whatever the decision is we're trying to make. So making sure that we use the proper information to make those decisions. Accounting judgments, a lot of times this is based on a judgment call. It is not, you don't have the exact answer like you do. Like in class when you're working a problem, okay, yes, there's going to more than likely the problem you're working is going to have a definite answer. But in all reality, a lot of times you're having to base your responses on judgment, on what you think, based on the past, based on what you foresee coming in the future, and based on right now, what's going on. That's where all those shades of gray come in. And we base that off of, a lot of times, the economic activity that we see, that we've seen, that we foresee. And if we make the wrong judgment, or if we don't make a good decision, then there are consequences. And sometimes those consequences can be as bad as the business failing, or not being able to pay our bills that month, or losing our job. So it just depends on what that main item is that you're focusing on. So if it was a car and you were looking to buy a car, like I mentioned earlier, and you base that information, you're like, yeah, I can buy this car, I can pay for it, and you don't base that information off of relevant information, like, well, I have this job, it's, I'm pretty sure I have good job security, I've been here for a long time, I make this amount of money every month and have been for a while, so I should be able to make this car payment. Okay, well, I would say that's probably relevant information. But if you're basing it off of, I have this interview next week and I'm going to be making double what I make now. I know I'm going to get that job and I'm going to be able to afford this car, so I'm going to buy the car today. Well, then next week rolls around and you didn't get the job. That was a bad decision, because now you have this car payment that you probably can't afford and you might end up losing it. So you always want to make sure that you try to base your decisions off of useful, relevant information. And that's in everything that you do. We tend to think of accounting as being boring and dry, but accountants are actually very, very helpful in businesses and helping businesses make decisions and interpreting things. Like I've said a few times, it is really good for you, even if you don't plan to be an accountant, to understand at least the basics of accounting. And just to kind of throw this out there, you want to make sure that if you aren't an accountant, but because I know that some of you said you own a business or you want to own a business, when you start a business, you need to either have the background, like at least a general background of accounting, or it would be very, trying to think, I don't want to say you have to do this, but you should definitely find someone to help you set everything up correctly. And accountants and really good bookkeepers are the way to go. There are tons of people that I've seen that have started their business, didn't set it up correctly, and they have been, it really can cause your business to fail, because they have to pay people to fix it. They have to pay fines because their taxes were wrong, or they never did their taxes because they didn't know they had to, or just a lot of other things. So you want to definitely make sure that you do your research, and you try to start it properly, so that there's less work and you're not running into consequences later on, hopefully. So we have two types of accounting. We have financial and managerial. Financial accounting is where we look at our financial statements. Financial statements we talked about these in last class, but last quarter, but you got like your profit and loss statement, your balance sheet, statement of cash flows. Those are all types of financial statements. These are used by investors, creditors, and government authorities. So when you think financial accounting, think outside the company. Financial, outside the company. Investors are outside the company, creditors are outside, government authorities are outside. Because you will probably more than likely have a question that asks you something to do with financial and managerial accounting. It could be, what's the difference between the two? Or it could simply be something like, investors, creditors, and government authorities are either financial or managerial. Something. So I'm not sure exactly what the question is, but I do know that you have a question around that. So just remember, financial accounting is outside. Managerial accounting, and a good way to remember this is manager. You manage the business. A manager is normally an employee of the business, so internal. Managerial accounting is inside the company. So with managerial accounting reports are generated for planning purposes, and one planning tool is the budget. We budget for the next year. We may budget if it's a new business just starting up. They may have a budget for the next year. They may have a budget for the next month. And some businesses budget for an annual budget. They also have a 5-year budget. Some have a 10-year budget, and the budget doesn't stay the same. Every year they're going to look at that budget, and it's probably going to change based on new information. It should change, actually. But budgets are prepared within the company. And then you have controlling, involves evaluating the plan and comparing the actual results to the budget. So this is where we have a budget, we have a plan in place, And now we've gone in and we're going to evaluate what the plan was and compare what actually happened to what we thought was going to happen. So we budgeted revenue to be $10,000 this month, and it was $8,000 this month. A good business, a business that is wanting to succeed and try, and all of that, is going to look at that, and they're going to, instead of just saying, oh, we didn't hit our budget this month, we got 8,000 instead of 10,000. All right, maybe next month. They're going to look and they're going to say, why did we not get that 2,000? Why did we not, the additional 2,000? Why did we not hit our budget target? Oh, maybe we should advertise more. Or maybe we spent a whole lot of money in advertising, and when we asked our customers to let us know where they found our information, well, no one really mentioned this advertising source. Maybe we'll try not using them next month and see what happens and save $200 there. Maybe we overspent on product, or maybe we purchased extra product that we didn't use that month, and we are kind of a new company starting out, and we don't have really anywhere to store this stuff. So we've got this extra product just sitting here that we really shouldn't have bought. Maybe next month we're going to try to better control our inventory and our purchases and materials and all of that. So you're looking at this budget, you're looking at the results that you received in the prior periods, and you're trying to evaluate areas of the business that you can increase profits and reduce expenses, because that will give you more money. You don't have to do this, but a lot of times when people don't watch their money, the inflows and the outflows, they don't really have a good idea of where their business is, and they tend to not know that they have a problem that needs to be fixed until it's like almost too late to fix it. So you want to keep an eye on this, and this relates back to your personal life. Same thing with your personal life. So you want to make sure that you're keeping an eye on your money, and you're not, taking on too many expenses and, falling into this same type of thing. You want to weigh the cost against the benefits. This is called cost-benefit analysis. So kind of like going back to that advertising thing, we'll just stick with that for a second. So we paid $200 for advertising for February, but when we had our customers tell us where they heard of us, only one customer mentioned that they heard of us from this particular advertising company. So cost benefit. Well, we paid $200 to use this advertising source. We only got one customer from it. Maybe the revenue that we made off the customer was $50. So we made $50, we spent $200. We could continue to try that advertising for a little bit if we wanted to, just to see if maybe it improved. Or we could say, well, right now the cost is higher than the benefit. We're going to try a totally different source. So, but that's that gray area that I talked about, right? Because if you just look at it as I hate using that term, but okay, if you look at it as, like black and white, extreme left, extreme right, you're like, okay, well, we spent $200, we only made $50. Obviously, we need to not use this because we lost $150. But if you look at it in the gray area, you're going to look at it and you're going to say, well, even though we spent more this period and we lost $150, I have heard that this advertising source is really good at what they do. This is the first month that we've used them. Maybe it happens to fall in, like we all know, there are some months of the year where people spend more and spend less. Tax season, people are normally getting refunds back, and they're normally spending more money around like March, April, May, something like that. Maybe this was in December around Christmas, and we are not selling toys. We're selling something else that people normally don't buy for Christmas. We're like, okay, you know what? People are probably broke because they're buying all their Christmas presents. They're not looking at us right now, but come January and February, they might. So we're going to give this advertising source another try. set a goal. Maybe we'll give them 3 more months and just see what happens. And who knows, maybe after that 3-month window, we're only paying them $200, but now we're making, $2,000 off of them based on the customers that they're bringing in. So you never know. That's where that gray area comes in. You have to make judgments based on all the information. So not just that one piece of information where we only got one customer that 1 month. You have to look at other factors too. Well, was that a slow month for us? Is it normally a slow month for us? What's going on in the economy? That takes us back to that prior slide where they talk about economic activity. So there's a lot of other factors. It's not just the number here and the number there. Let me get you checked in real quick. And then also, if you could sign in, Jordan, and I can, let's see here. Just so, I don't know if I know that they call. Let me get you checked in real quick so that hopefully they don't. All right, thank you. So this is on page 829. So this is just breaking financial and managerial accounting down just a little bit more. So again, financial, we have external, think external, financial, and managerial, think manager. Manager works for the company, within the company. So primary users, the people who primarily use financial accounting information are external people that are thinking about investing into our company, people who might lend us money, maybe we need to borrow money, they're creditors, and government authorities. Those are the primary users of our financial accounting information. The purpose is they use this information to help them make decisions. So investors and creditors can make investment decisions and credit decisions based off of the financial accounting information that they receive from our company. Focus and time dimension of the information. So for financial accounting, we're using relevant and faithfully representative information, and we focus on the past. Financial accounting focuses on what has happened in the past. For example, in 2017, our actual performance reported in 2018. So we're looking at the past to base our decisions off of for now and the future. Rules and restrictions. Financial accounting is required to follow generally accepted accounting principles, also known as GAAP. And public companies are required to be audited by an independent CPA. The scope of information. Summary reports are prepared primarily on the company as a whole, usually on a quarterly or annual basis. And then behavioral, there's a concern about the adequacy of disclosures. Behavioral implications are secondary. With managerial accounting, our primary users are internal within the company, employees, management. The purpose of managerial accounting is to help managers and employees plan and control operations. The focus and time dimension for managerial accounting, relevant information and focus on the future. For example, the 2018 budget being prepared in 2017. So in 2017, we created the budget for 2018. Managerial accounting is not required to follow GAAP, generally accounted accepting principles. And then detailed reports prepared on parts of the company. So we have products, departments, and territories. These are often prepared on a daily or weekly basis. So we're creating these reports for management to use to identify any areas in the business that may need to be improved. And then the behavioral, there's a concern about how reports will affect employee behavior. So if a report there's like a negative report, it could make the employee behave poorly. I don't know. So like an example would be like, I think I've used this in a previous class, but like accounts receivable. We have a person or a team that manages accounts receivable for our company to make sure that we're getting all of our money that is owed to us. And our accounts receivable report is like 10 pages long. That's not good. We don't want that. So, we're running these reports because we need to know. We need to know if people are not paying us. Because if people aren't paying us, why are we still selling them products? They're not paying for it anyways. So, and I guess a good example of this would be like, I don't know, like a service company. Let me think. I don't want to use any names. Anyway, so there's a company that produces $100 pens. No, we'll just go with that. $100 pens. Okay, you can buy a pen for $100. It's very fancy. The ink costs a lot of money, right? It's made of like gold or something. I don't know. But so this company produces $100 pens, and we have this customer that bought a ton of these pens from us, and so they currently owe us like $5,000, and they still haven't paid us, and they bought them back in like November or something. So they've owed us $5,000 for several months, and they just placed another order for the same amount of pens, and we're just going to sell them the pens and hold them on our accounts receivable. But that's because we're not watching our reports, right? We're not even looking at this stuff. We're just taking money and sending stuff out. That's why it's important that you look at your records. Because what I would say is, no, you hold that order and you tell them they cannot get that order until they have paid you the $5,000 that they owed you on the first order. But that's going to sit on your accounts receivable report. And if you don't look at that report, you're not going to know. But if you pull that report and you see that there's 10 pages long of people who have owed you money, then you're going to go to the person that's over your accounts receivable and you're going to say, hey, look, can you please start calling these people and collecting this money, because this is a lot of a 10-page accounts receivable report is a lot. So I'll just make it a little easier. Let's say there's 20 people that are sitting on our report. There's 20 customers that haven't paid us. Okay, well, now this report, we run it again next period, and there's only 10 people on it instead of 20. How do you think that accounts receivable specialist is going to feel, or whoever it was that we told to go look into that and get that fixed? The report went from 10 to 20. I mean, from 20 to 10. They brought that report down. They collected money from 10 of those people, and now there's only 10 people there that are still owing us money. They're going to feel good because they have accomplished something. They've shortened the report, which is what they were asked to do. So that's going to raise their morale. Let's say there were 20 people on there, and we asked them to go collect this money, and they went and they tried to collect the money, and there's still 20 people on there. Or there's more than 20 people on there. Well, now they're going to feel bad. It's going to negatively affect their morale. And that can also, in either way that it goes, can affect their job performance. And it can also affect the performance of others. So you want to make sure that you try to stay on top of these things as best you can, so that hopefully your business or the company that you work for doesn't get into that type of situation where you're having to try to go back and clean up, because it can be very stressful as a whole in the whole business. So it's very important to have these reports, for management, so that management can make good decisions, so that we know we're getting our money, we're collecting our money. Same thing goes for paying out our money. If we owe vendors and we're not paying them, they're going to tell us that they're not going to send us our product. They're going to do the same thing that I just said to do with our accounts receivable. They're going to say, no, you owe us $10,000. You owe us, I don't know, I'll just stick with $10,000. No, you owe us $10,000 from the last shipment that we sent you. Or you haven't paid on the last 3 invoices and you've got a balance of $10,000 on an account here with us. We can't send you anything else. So now you can't get your product. Now your customer's not going to get their product. Now people are going to talk. It's going to be bad for your business. So you want to run these reports regularly, and you want to review them regularly. For financial accounting purposes, if you end up needing to borrow money, or if people are looking to invest in your company, government authorities are asking for these reports, you want to have these reports readily available, and they need to be accurate. And in order for them to be accurate, you need to keep up with your accounting data. And the same thing goes for your, personal, right? Sometimes we spur of the moment decide we want to make big purchases. I'm going to go, you know what? I'm driving past this car dealership. Man, that car looks really good. I'm just going to go in and just talk to them. And then they're like, oh yeah, well, we can take your trade-in on, and your car note will actually be $200 less than what you thought it would be. And you're like, okay, maybe. Well, is all of your information, your personal information, do you really have a good idea of where you are personally? Or have you not really looked at your personal finances in a while? So you just got to keep all of that in mind and try to stay on top of money in general, I guess is what I'm trying to say. And I'm trying to relate it back to personal life because there are a lot of people in here that aren't accounting majors. So I'm trying to give you ideas of how to find this interesting. So management accountability is the manager's responsibility to the various stakeholders to wisely manage the organization's resources. Managers are supposed to manage the organization's resources wisely in a way that will make the organization money and definitely not lose money for the organization. Stakeholders have an interest in the business, and examples of stakeholders are customers, creditors, suppliers, and investors. Here we have, this is on page 830. So we've got management's accountability to stakeholders. And so here it's telling us that stakeholders for operating activities are suppliers, employees, customers. Suppliers provide products and services, and it is management's responsibility, and it's our responsibility to make timely payments to those suppliers. Employees, they provide their time and expertise. It is our responsibility as a management to provide a safe and productive work environment and to pay wages and salaries to those employees. Customers, they provide cash. They buy our products. So it is our duty to provide products and services that are safe and free of defects, to back up the products and services that are provided. So, if they get a faulty product or something happens, it's our responsibility to fix it or send them a new one. Stakeholders, when you're talking about investing activities, we have asset vendors. Asset vendors provide long-term assets, and it's our responsibility to make timely payments to those vendors. Financing activities, we have investors and creditors, and investors provide cash and other assets. It's our responsibility to provide a return on investment. They're investing in our company because they are hoping to make money. So it's our responsibility to provide them a return on investment. Creditors provide us cash. They give us cash for the same reason, right? They want to make money. So it's our responsibility to pay them the principal and the interest. And then actions that affect society. So we have governments and communities. Governments provide the permission to operate. So if they say we can't operate there, then we can't operate there. Otherwise, we're going to be fined. So that's something else to kind of note for anyone opening a business, making sure that you can operate there, which you pretty much can operate any business anywhere for the most part. There's a few that you can't. But I haven't heard anyone mention any of those. Governments, it's our responsibility as management to obey the laws and pay our taxes. And then communities. Communities provide human and physical resources, and it is management's accountability to operate in an ethical manner to support the community, ensuring that the company's environmental impact does not harm the community. So, I'm sure, I don't know if y'all have heard of it, but, there were some companies where they were dumping waste in water areas and stuff like that. Well, that's harming the environment. And they were fined and no longer allowed to do that kind of thing. But, just make sure that you're not, that you're trying to, you're not harming the community, and maybe you're even helping to make it better. Like new businesses create new jobs. So that's that tab. So today's business environment, we're shifting toward a service economy. There is global competition. So to be competitive, many companies are moving their operations to other countries to be closer to the new markets. Sorry. Other companies are partnering with foreign companies to meet local needs. For example, Toyota, which is a Japanese company, has 15 manufacturing plants here in North America. Time-based competition. So time-based competition, you've got the internet, e-commerce, express delivery, which speeds the pace of business. Customers who instant message around the world will not want to wait 2 weeks to receive merchandise that they purchased online. So time is the new competitive turf for world-class business. To compete, companies have developed the following time-saving responses. So they have advanced information systems, also known where they use enterprise resource planning, ERP. They also have e-commerce, and they also have just-in-time management. And ERP systems integrate companies' data. E-commerce allows companies to sell products to customers around the world. And just-in-time is an inventory management tool where the inventory held too long could become obsolete. So what they do is stored goods are produced as needed just in time for the order. TQM, Total Quality Management, is a philosophy of continuous improvement in products and processes. TQM creates a culture of cooperation. Each step adds value to the end product, and this is referred to as the value chain. The economic, social, and environmental impact of doing business is referred to as the triple bottom line. And the triple bottom line includes people, profits, and planet. So this is on page 832, and this is an IMA statement of ethical professional practices. I'm not going to read through all of this, but you should definitely read through it on your own time. But I am going to just mention, competence, confidentiality, integrity, and credibility. Management accountants have a commitment to ethical professional practice, which includes honesty, fairness, objectivity, and responsibility. And then this just goes into more detail about all of those. So in your book on page 833, there is a try it, and I would like for you to try it, please. And I'll give you just a few minutes, and then we'll run through those. I'm going to go ahead and start. So what do we think the first one is? Helps creditors make lending decisions. Yeah. What about helps in planning and controlling operation? And then is not required to follow GAAP. Has a focus on the future.
Really both. Financial.
And then summary reports are prepared quarterly. So financial, managerial, financial. If you don't have that. And write it down because you can use these to go back when you're studying. You can go back to your try it and you can use these while you're studying. Very good. So we're going to describe, oops, I'm also adding this to our slides for the next time we have class. So it'll be in here for anyone that doesn't have the book. All right. So we're going to describe the differences between service, merchandising, and manufacturing companies. So how do service, merchandising, and manufacturing companies differ? Service companies sell their time, skill, and knowledge. So all of their costs are period cost, and they're expensed in the period that they are incurred. So when we say service companies, what are some examples of some service companies? What can we think of? A service company that sells their time, skill, and knowledge. Maybe like lawn care, so they service our yard, or so they're, they are coming out and cutting our grass every month. So when they cut our grass in March, all the costs associated with that are recorded in the period of March. I don't know what is. Maybe, I'm not sure what they do. What do they do? I know they do like roadside service, right? Mm-hmm. They do anything else though? I'm not 100% familiar with them.
Sometimes they can help you fix it from the phone. So I guess they go with the knowledge.
Yeah. That would probably fall within that service company. Merchandising. What about merchandising? So they resell. Go ahead.
Costco.
Mm-hmm. They resell products they previously bought. Costco. Really a lot of, you could, tons, right? People, a lot of times that's people's side business these days. That turns into a full-time business for some people. I'm like, if I only had figured out how to sell on Amazon 10 years ago. So, merchandising companies, they resell products they previously bought from suppliers, and a lot of times they, buy things in bulk or at a, when things are on sale so that they can turn around and sell it at a price more than what they paid for so that it's worth it for them to resell it. They have, their cost of goods sold is an inventoriable product cost, which we call a product cost. And the manufacturing companies, they're the ones that are actually creating the products. So, they're actually, they've got the assembly line, they're putting everything together. Manufacturing companies convert raw materials into finished products. There are 3 types of inventory. We have raw materials inventory, which is RM, work in process, WIP, and finished goods inventory, FG. So raw materials, this is the material that we use to create the product. So going back to our tablets, because we are a Smart Touch Learning tablet company, Our raw materials would be like the keys and the, the outer box that houses everything, and the computer components within it, and the screen and all that. So we've got all these different pieces of raw materials that we have pulled together to create this tablet. Well, once we start taking those raw materials and putting them together, we're piecing everything together. Now it is in work in process. So work in process, this is goods that we have started to complete, but they're not done yet. So we had all the little materials. And we grabbed them, we took them over to work in process and started putting everything together, but it's not done. And then once we complete the tablet and it's one full tablet, now we're moving it to finished goods. It's completed, and we're holding it in finished goods until we sell it. So let's go back one. So we have a try it on page 835. Let's work on that for a few minutes, and then we'll run through that one.
This is the right accounting. I said I didn't get a book, but if I go down there, they should be able to.
Yeah, they should be able to get it for you. Just it's accounting 202, financial and managerial accounting.
Oh, thank you.
No problem. 835. So we'll go ahead and start running through this one. So number 6, a service company.
E.
Dentist office, E. Yep. So out of all the options we have, the dentist office would be, is the service company. And then for number 7, a merchandising company. D, department store. And then number 8, manufacturing company.
B.
B, company that makes cast iron pans. And then number 9, period cost. A, salaries paid to lawyers. And then number 10, product cost.
C.
C, tires used in the manufacturing of automobiles. Very good. So like I said, make sure that you have those. So the order of answers from 6 to 10, 6 is E, then we have D, 8 is B, 9 is A, 10 is C. So if you want to go back and look at that, you can. And then also real quick on this page, I do want to note that you do have your cost of goods sold formula on this page, page 835. So you'll see that here, beginning finished goods inventory plus cost of goods manufactured equals cost of goods available for sale. And then if you subtract out your ending finished goods inventory, you're left with your cost of goods sold. So I just want to point that out, that formula is on page 835. And then you also have the formula on page 834 as well for cost of goods sold. And you'll just notice that the formula is slightly different for merchandising companies and manufacturing companies. So for manufacturing companies, that's the one that I just ran through with you. And we're subtracting out our ending finished goods inventory. But when we look at merchandising companies, theirs is a little different. They are starting with their merchandise inventory plus purchases and freight in equals the cost of goods available for sale minus the ending merchandise inventory leaves us with our cost of goods sold. And we'll run through this again, but I just want to point out where those two formulas are located in your book. And this is more of a visual here. So on page 836, in chapter 16, so we've got 3 different types of companies. And this is our financial statement comparison for each of those companies. We have a service company, a merchandising company, and a manufacturing company. And they all have the same revenue. So we see here their revenue is $7,600. For a service company, we call it service revenue. For a merchandising company, we call it sales revenue. For a manufacturing company, we call it sales revenue. So this is a good slide page to go back to, slide 16, page 836. If you're trying to figure out the differences between the different types of between the different companies, and also to see what their income statements and balance sheets look like, because they are different. So for a service company, we have our service revenue on our income statement, and then we're going to subtract out our expenses. We have salaries expense, rent expense, utilities expense. Remember when we worked on our assessment last time, you know, I was telling you, you know, your revenue will go here on the right. And then if you had more than one type of revenue, though, then you would have a subline on the left-hand side. But in this case, we do not. We only have one revenue account. But then when we get to our expenses, we have multiple expense accounts, because you are going to be creating an income statement for your assessment. So I'm kind of running through this again just to try to jog your memory a little bit. So for your expenses, we have multiple expense accounts. So we're going to break each of those out individually on the left. And then we add up all of our expenses and put the total expenses on the right. So our total expenses were $5,200. And that, then we're going to take the revenue minus expenses, leaves us with our operating income, which is $2,400. That's our basic income statement. That's the income statement that a service company uses. And that's the one that we should be pretty familiar with, because that's the one that we were using in our last class. And then our balance sheet for a service company, same thing. We had to create a balance sheet last class as well. So for our balance sheet, we have we're just looking at our asset accounts. So we've got cash, accounts receivable, equipment, Remember, we put these in order of liquidity, and liquidity is how quickly
You can access it like cash.
we can access it. We can convert it to cash. So how quickly we can convert this asset into cash, liquidity. The balance sheet is listed in order of liquidity. The most liquid asset that we have is cash because it's cash. And then if we were looking at accounts receivable and equipment, more than likely we will get our receivables more quickly than we would be able to sell equipment and get cash for the equipment. So that's why accounts receivable is before equipment. So we add all of those up, all of those individual accounts up, and we get our total assets, which we've listed here. For merchandising company, so for our income statement, we've got our revenues. So we've got sales revenue of $7,600. And then under that, we're listing out our cost of goods sold. So our cost of goods sold, we're going to list out beginning merchandise inventory, and the beginning merchandise inventory is $2,000. Purchases and freight in of $3,800. We're going to add those together. So we're going to add our beginning inventory, our beginning merchandise inventory, plus anything that we have purchased. So we have this inventory, we're purchasing and bringing in this inventory. So we add that all together to see what the total amount is that we have that's available. And so the cost of goods available for sale is $5,800. Well, then we're going to take the revenues minus what's available for sale, and that gives us our ending merchandise inventory. Cost of goods sold, we're going to subtract this ending merchandise inventory from this cost of goods available, and this is going to give us $3,600 for our cost of goods sold. And then we're going to take the $7,600 minus the $3,600 to give us our gross profit, which is $4,000. We bring in our selling and administrative expenses of $1,600, and that's going to leave us with our operating income of $2,400. So if we look back on page 834, it shows us our cost of goods sold formula, how to calculate cost of goods sold. And you see here beginning merchandise inventory plus purchases and freight in. They're doing the same thing. It's just listed out on the income statement, but they're doing the exact same thing on the income statement here that our formula is showing us on page 834. So you can refer to either one of these pages, whatever works best for you, or both, if you have to calculate this. And then when we get to our balance sheet for our merchandising company, we have our cash, our accounts receivable, and then we also have a line for our merchandise inventory, and then we also have a line for our equipment. And they're also listed in order of liquidity. For a manufacturing company, same thing. We have the formula listed on page 835 for the manufacturing company. When we're looking at the manufacturing company income statement, we start with our revenues again, and then we have our cost of goods sold. And so we're breaking out the cost of goods sold. We've got our beginning finished goods inventory was $2,000. Then we have our cost of goods manufactured, which is $3,800. We're going to add those together to get a total cost of goods available for sale at $5,800. And then bring in our ending finished goods inventory, which we have as 2,200. So our total cost of goods sold is $3,600. And then we're going to take the 76 minus the 36, and that gives us 4,000 for gross profit. And then our selling and administrative expenses, we brought those in, they're $1,600. And that's going to give us a total operating income of $2,400. Our balance sheet, start with cash. So we have cash, accounts receivable, and now we have these three other accounts on our balance sheet. We've got raw materials, work in process, finished goods, and then we have equipment. These are also listed in order of liquidity. And then we're going to add all those up, and we get our total assets of $83,750. So this is a good slide to refer back to when you're calculating your cost of goods sold, or if you have a question, then ask for, for you to, what is the cost of goods sold, or what's the cost of goods available for sale, or what was your beginning finished goods inventory, what was your ending merchandise inventory. Because you can literally look at this and just plug in the numbers that they give you, and then you just calculate what's missing. Right? Like, remember, like, I don't know, like 2 plus X equals 4. So you can plug everything in and figure out what's missing, or you can go back in your book to either page 834 or 835 and do the same thing. Just plug in the numbers in the formula and then calculate what's missing. Oh, here we go. Okay. So now we're going to talk about how costs are classified. So we're going to classify cost for service, merchandising, and manufacturing companies. And this is not supposed to look like that. And if you have the slide pulled up, you would know that. It's a little bit more jumbled on here than it is on the slide. But basically, how are costs classified? We've got all sorts of, we've got our direct cost and we've got our indirect cost. Let's just move over to this one. So actually, let's not, let's go back. All right, so we've got direct cost and indirect cost. Page 836. Direct costs are costs that can be easily and cost effectively traced to a cost object. You can easily identify this cost. It's a direct cost. So you could think of like when milk is a direct cost for making ice cream, unless it's ice cream that doesn't have milk. But let's just, assume that we're making ice cream that requires milk. Milk is a direct cost to make the ice cream. It's directly related to that product. Indirect cost, these are costs that cannot be easily or cost effectively traced to a cost object. So, like, for example, a production supervisor, they oversee production. So they are not directly associated with the production of all the ice cream that we're making. They are overseeing everything, not just the ice cream. Same thing goes when we're talking about materials and when we're talking about labor. You have direct materials and you have direct labor. Direct materials, these are the raw materials that are used to produce the item. Direct labor, this is the labor of the employee who is producing the item or working on the product. And then manufacturing overhead, MOH, this is the indirect product cost that's associated with producing the product. Manufacturing overhead includes indirect materials, indirect labor, and it also includes factory cost for rent, utilities, insurance. So right here we're looking at product cost, and this is on page 838. So we have the cost that was incurred, and then we are identifying if this cost is a period cost or a product cost. So this is a good slide to refer back to. So for example, when we look at depreciation on manufacturing equipment, is this a selling and administrative cost? No. Direct materials, is it a material that we're using to create the product? No, it's depreciation on the equipment, right? What about labor? Does it have anything to do with labor? No, it's equipment. So that's one way to kind of like go through these if you have questions asking you to identify certain costs. Well, we know that depreciation on manufacturing equipment is not selling and administrative. It has nothing to do with selling and admin. It's manufacturing equipment. It's not a material. It's not labor. So it has to be part of manufacturing overhead. When you look at depreciation on office equipment, the office, okay, office administrative. So we're looking at the office equipment depreciation. It's going to fall under selling and administrative because office administrative. Advertising. Well, it's not a direct material, direct labor. It's not manufacturing overhead. It doesn't have anything to do with manufacturing. So it has to be selling and admin, right? Advertising, selling and admin. So it's kind of the process to, like, when you're going through and you see something, try to kind of like think about what it is that they're asking and then run through and pick the best possible one. And this is a good slide for you to refer back to help you with any questions similar to that on 838. Slide 20. So prime cost and conversion cost. Prime cost combine the direct cost of direct materials and direct labor. Conversion costs are the cost to convert the raw materials into finished goods. Direct labor plus manufacturing overhead. So in this little area down here, we see we've got all the prime costs on the left, the conversion costs are on the right. So prime costs are direct materials, conversion costs, manufacturing overhead. And then when those two cross over, that's where we have our direct labor. So this is just more of a visual to see what they're saying here. All right, we have another try it on page 839. So I'll give you guys a couple of minutes. Does anyone have 11?
Direct labor.
Direct labor. There's actually, so identify each cost as a period cost or a product cost. And if it is a product cost, further indicate if the cost is direct materials, direct labor, or manufacturing overhead. Then determine if it is prime or conversion. So there's a lot going on here. So for this first one, you're right, but it's also, so we identify that it is a product cost. So now we know we need to move forward, right? So it's not just a period cost. It's not a period cost. It's a product cost. If it was a period cost, we would just stop there. But we know that it's direct labor, so therefore there's more involved. So it is a product cost. It is direct labor, and it is also prime and conversion. Prime and conversion for wages of assembly line workers, because direct labor falls right here in the middle. Can you see my? Yeah. So it's both prime and conversion for that first one, for number 11. What about number 12?
Direct labor.
So number 12, it doesn't really show very well on there, does it? So for number 12, if we go back to the, see here. I'm gonna have to fix that slide. That slide is not very pretty. All right, so I'm going to tell you that, so for number 12, this, if we look right here on this slide, it shows us, so we've got some period cost examples. All these are period cost. And then we've got product cost examples here. And then it lists out direct materials, direct labor, manufacturing overhead. So when we're talking about wages of the office receptionist, it is period cost. So, and this is, so when we look here, when you think office administrative, so like an office assistant, an administrative assistant, something like that, that might help jog your memory. Anytime that it's office related, it's going to fall within that administrative area. So we're talking about wages of the office receptionist. They're going to fall within administrative, which is a period cost. Property taxes on the factory. Would you say manufacturing overhead? Yeah. Yeah, so it's a product cost, yes. So this is a product cost. So we need to move forward, and we're identifying that it is a manufacturing overhead cost, which falls within conversion cost. So for 13, the answer is product, manufacturing overhead, conversion. Number 14, sugar and flour used to make cookies.
Direct materials, product cost, and prime cost.
Yes. So the sugar to make the cookies is a direct material. Direct material falls in product. So we have product cost, direct material. Direct material is a prime cost. So for number 14, you have product, direct material, prime. Number 15, salary of the factory maintenance supervisor.
Product cost, manufacturing overhead, and conversion cost.
Yep. So the salary of the factory maintenance worker, that is going to fall under your product cost, manufacturing overhead. It's the factory maintenance supervisor. And manufacturing overhead falls within conversion cost. Number 16, salary of the sales manager. Yep. Selling and administrative. So this would be a period cost. Yep. For number 16. Good job. All right. So learning objective 4. Does anybody have any questions about any of that? Okay. Learning objective 4. Prepare an income statement and schedule cost of goods manufactured for a manufacturing company and calculate the cost per item. So the income statement. We're calculating the cost of goods sold. So we have the finished goods inventory account provides information for the cost of goods sold section of the income statement. Gross profit. Gross profit equals your net sales revenue minus your cost of goods sold. Operating income. Operating income equals gross profit minus sales and administrative expenses. This is the income statement for the manufacturing company. This is on page 840. So you can use this to refer back to see what the income statement is supposed to look like for a manufacturing company. Also to kind of like to help you with setting up your cost of goods sold if you have to calculate that. And then you'll also see below that where they have all of the selling and administrative expenses listed out, your operating income, other revenues. Just pointing out the blue areas. So COGS, COGS, cost of goods sold, is a product cost. And then S&A, selling and admin, these are period cost. So the cost of goods manufactured is the manufacturing cost of the goods that finished the production process in a given accounting period. Costs are determined from activities that took place in the past. Calculating the cost of goods manufactured. So here, this slide is on 841. We're looking at, we've got our balance sheet and our income statement. On our balance sheet, we've got our product cost. Product cost, we've got purchases of raw materials plus freight in. That goes into our raw materials inventory account. Our direct labor and our manufacturing overhead flow into our work in process inventory account. And then once that work has been completed and the product is ready for sale, it moves to our finished goods inventory account. When we sell it, it moves out of finished goods and into cost of goods sold. So now on our income statement, we have our sales revenue minus our cost of goods sold, which is the product cost. See, this is all product cost over here. So sales revenue minus cost of goods sold equals our gross profit. Then we subtract out our selling and admin, which is a period cost, to give us our operating income. This is the same thing. This is just showing us the calculation of cost of goods manufactured. So this is our schedule of cost of goods manufactured. So we've just broken this out even more for cost of goods sold. So we're going to start with our beginning work in process inventory. We started with 80,000. And then you'll see here, these all should look familiar. So we've got indirect materials. We've got our beginning raw material inventory. We've got our purchases of raw materials. We're going to add that together to give us the raw materials that are available for use. So we have a total available of 420,000. And then we ended with 65,000. So that means that we used the difference, which is 355,000, the difference of the two. Well, then we're going to list out our direct labor. And then we've got our manufacturing overhead for indirect materials. Indirect is something that cannot be easily traced to the product. Indirect labor listed here as well. Depreciation, plant utilities, insurance, property taxes. Add all those up to give us our total manufacturing overhead of 83,000. And then that's going to give us a total manufacturing cost incurred during the year of 607,000. Our total manufacturing cost to account for is this 687,000. Beginning and this total during the year. So then our ending work in process inventory, we're going to subtract that out, and that's going to tell us that our cost of goods manufactured for this year is 660,000. And it is a good idea if you are a visual person or a learn as you do type of person to, when you're working problems and stuff, to go back and look at these slides where they have all this listed out. And I mean, maybe even, like next to it, go through and calculate everything and write out how you calculated it. And then you plug in your numbers from your problem to solve whatever problem it is that you have. So like right here, we're taking the 350 plus the 70. So just write a little plus sign right there. 70 plus that equals that. You can even put an equals right there. And then when you go back and you're plugging numbers in, because let's say that they ask you, well, what was your beginning raw materials inventory? And they tell us that you had the purchases of 350 and you had available 420. Well, you're going to have to figure out that you'd have to calculate the 70. And sometimes it's easier for people just to visualize it and see it and plug it in. And other times it's easier for you to write out the full equation and solve it that way. Whatever works best for you. Doesn't matter how you do it as long as you do it, right? And you get to the correct answer and you understand how you got there. Flow of cost through Smart Touch Learning's inventory accounts. This is page 843. So we're starting with our raw materials inventory. This is all those little pieces. So we started with our beginning inventory of 70,000. Well, here we go. They already put our pluses and our equal signs and our minus signs in here for us. So this could be another slide that you could use as well. And what I like about this slide is it actually is breaking each section out for you. So if you're just looking at work in process inventory, then you know to just look at these accounts right here because this is how you calculate work in process inventory. If you're only trying to calculate finished goods inventory and they gave you this information, then you could just look at this slide, this area, this section. So this is a good slide to refer back to as well. I feel like I have gone through these a few times though, so I'm not going to read through each of these again. But just know that you can go here as well to see how your raw materials inventory is structured, how your work in process inventory is structured, how your finished goods inventory is structured. And also you can use this to help you to calculate what those are as well. Calculating unit product cost. So managers make decisions on pricing products based on unit cost. So here we've got the cost per unit is found by dividing the cost of goods manufactured by total units produced. The cost per unit is used to determine the cost of goods sold for the units sold to the customers. And so they've given us this little formula here. We have 2,000 tablets that we sold. The unit product cost was $300 per tablet. So our cost of goods sold is $600,000. Do y'all have any questions about any of that?
So basically, our assessment is on service and merchandising companies. Like, that's what it's basically is, right?
So your assessment, you're selling tickets to a show. So it's in the Excel, but so what you're doing here is you're selling tickets to a show. We'll circle back to that after we finish chapter 16. Are there any questions about any of this so far? Okay. All right. So calculate the cost per service for a service company and cost per item for a merchandising company. So how is managerial accounting used in service and merchandising companies? Managers of a service and merchandising organization makes decisions on pricing based on cost per service or cost per item. So here we've got the total cost divided by the total number of services provided equals the unit cost per service, which is similar to what you were talking about with your assessment. The total cost of goods sold divided by the total number of items sold equals your unit cost per item. And so we've got the total cost here divided by the number of items equals the unit cost per item. So when you're looking at your assessment, you have to figure out your sales revenue per show. So like here, you're talking about your total costs, the services, what you're going to do, and we mentioned this earlier, but for your sales revenue, you have number of tickets, cost of ticket, and then what is the sales revenue per show? So how would you calculate that to find the revenue? So we're trying to figure out what our revenue is, which falls on our income statement. We're going to take, what is included in revenue? How do we calculate revenue? I know y'all know. Yes, I'm like, I know you know because you said it earlier. It's just been a long long little time, huh? Yes. So you would take the number of tickets times the cost of the ticket would equal your revenue. And that's how you would calculate your revenue. And then, so that's how you'll do that. Does anyone have any questions so far with chapter 16?
I have a question.
Yes.
So over here, it says total cost of goods sold. So is that a number that's a projection, or how do you get that number?
You are going to calculate what the total cost of goods sold is based on the information that you have. Hold on. What slide are you on?
I think it's 16. Oh, no, it's not that.
So this does show it though. So on slide 16, you'll see, hold on, get a little cursor out. So for a merchandising company, this is our cost of goods sold here. And so if we're trying to figure out what the cost of goods sold is or how to calculate it, we see here that we have a total cost of goods sold of $3,600. To calculate that, we had to take the goods available for sale minus the ending merchandising inventory to get the cost of goods sold. And now let's say, for example, that they didn't tell us the cost of goods available for sale, and instead they said, your beginning merchandise inventory is this, your purchases and freight in is this, and your ending merchandise inventory is this. Calculate cost of goods sold. You could still calculate it. So a question can be worded different ways. It could say cost of goods available for sale is this, and your ending merchandise inventory is this. And you need to know that that combined equals your cost of goods sold when you subtract out your ending inventory. But don't get hung up on it and think, oh my gosh, they're not telling me what the goods available for sale are. I can't calculate this. More than likely, if they're not telling you the available for sale, it's because they told you the beginning merchandise inventory, and they also gave you the purchases and freight. So that's why I'm like, it's good to kind of come back and look at this layout as well, because it shows you everything that is included in calculating that. Do you have any other questions, anybody? Okay. All right, so we're going to take a short break. And